Um, we got a reasonably small group, but it is Sunday night, so that's kind of what these are like fireside chats more so than like big old meetings. So I'm curious if anybody has any feedback or opinion on what what is going on in the market you are in right now at this moment. Is it more the same, or people having different experiences, or what? Mary Lou, go ahead.
Yeah, so I'm in Washington, D.C. market and, part of Maryland. And, this particularly D.C. Prices are basically, they've leveled out, but the prices are really high. Rentals are ridiculous. Um, the rental prices are so high in some areas, it's actually cheaper to buy a house than it is to rent.
Hmm.
Um, and our gas prices, I mean, I can drive 50 miles out of town and get gas literally $1 cheaper. So it's like $5 or more in DC.
Wow, I would guess that that's because of taxes, local taxes.
That is local taxes, but even in Maryland, um, it's still the closer you are to town, the higher the prices are. That's the bottom line. The
Hmm.
further you go away, the cheaper the prices are.
Well, they might be higher in the nearby parts of Maryland because people are willing to drive 10 miles to go get cheaper
Exactly.
gas.
Yeah. And I mean, I personally, well, I sort of go between DC and Southern Maryland. I always buy my gas in Southern Maryland because it's $1 cheaper.
Hmm.
So every time I go down there, I buy gas. But the real estate market hasn't really gone down very much here. It's slowed down a little bit,
Hmm.
but the prices haven't adjusted. They have not gone down.
Yeah, that's kind of the story right now in the Midwest and the Northeast.
Mm.
Now it's shifting in the Northeast. Like you can see a real distinct, the Northeast was actually still going up until 5 or 6 months ago, and now it appears statistically to be doing what you're saying, which is just going sideways. Um, but of course, in other parts of the country, like the Sun Belt, they are having pretty drastic adjustments, particularly in rents. The rents in a lot of Sun Belt cities have dropped like 20% because they of course got the most jacked up during COVID when everybody was like, "Ah, I can work from anywhere. I think I'm going to go someplace warm." But also that was where there was a lot of overbuilding. And that was not just a COVID thing that's been going on for a while, of course. So yeah, we'll see what happens in the next 6 months where you are, because the question is it like the Northeast and the Midwest were going up even as the rest of the country was either flat or going down, and now the Northeast is kind of flat. So the question is it going to go down, or is it going to pick back up again? And my guess is down. And then the Midwest will follow it. We've still got, all these people here in Cincinnati going, well, I mean, days on market is longer, but really prices are still going up some, like 2%. Like let me re-say that. Like a normal amount. 2% is like a normal amount for Cincinnati. And if this follows other things that I've seen in real estate over the years, the Midwest and the Northeast will just follow suit with the West and the South. It'll just take a minute. Mark Twain said of Cincinnati, Ohio, where he lived for a few years, if the world ever ends, I'm moving to Cincinnati because everything there happens 10 years later. So who else can tell us what's going on in their markets? I'm just looking for like opinions, like on the street. What does it feel like? Mary, what's going on in Nashville?
Well, it's funny you should say that. I just put a house on the market that I bought last June. I was going to work with a couple investors, and though they both backed out. Well, the first one didn't, but I got a better offer from a second one. And now we have had showings this morning and all day, and now they're offering less than I purchased it at a foreclosure auction.
They're offering less than what you purchased it at?
Yeah, and I purchased it based on the investor saying this is what we need to buy it at.
Hmm.
So we're getting ten to $15,000 less offers today than we got. And this was an experienced investor who knew what to pay for things last year.
Yeah, here in the South. I mean, that's
Well,
kind
and
of
it's just really interesting that there's one just a block down and around the corner that a wholesaler, high dollar wholesaler, sold it to 75 for a quarter, 25% less square feet. And now it's on the market after rehabbing it for over $400,000, and they're dropping it. It's
hmm.
very nice rehab in an area that's turning, but it's the first five rehabs in the neighborhood with a bunch of apartments that have come in.
What's your plan B?
The plan B is to go ahead and rehab it ourselves and then put it on the market. It won't be a huge, I mean, plan B is we talk about rehabbing and what we need to put into it as a 3-1 or go ahead and put the second bath in. And there's a comp down the street, like six houses away, I think 4 or 6 houses away, that sold for 390. So, and I've
But wh-
got the offers today were 210.
but what if by the time you're finished with the rehab, it's even less?
Then I will do shared housing with Tiffany.
There you go. See, that's the plan B.
And the other the other option is to take a loss and move on and go lend the money out at 10 and 12%.
Well, let's make that like plan
Let's see.
G.
Yes. Yes.
Let's
Yes.
let's yeah, because I mean that we've all many of us here went through the biggest housing crash that I expect to see in our lifetimes. And it felt like it was bottomless and it felt like it was forever. But the reality was it was about 2.5 to 3 years to get to the bottom of the market. And then it's been going up ever since then. And
And I
by the
agree with you because I started lending money and doing this in 2007 and I was doing funding wholesale deals and rehabs when the margins were skinny in that time period. So I've been
hmm
through that. I've seen it.
hmm
There's still money to be made if you find the right deal.
And I think sometimes it's better to write it out under some different thing that you thought you're going to start with and
Mhm.
wait for the values to recover than it is to just actively decide to lose money.
Yeah, well, if I had a deal waiting that, then I would say it, but right now I don't. And I'm not looking to jump into any other deals that aren't in my local neighborhood that I understand a whole lot better.
Hmm. Okay. Frank, you're in Northeast Ohio, right?
Right, right.
And that's been one of the low dollar markets in the country for many, many years. Is
Really?
anything uh
I wouldn't call it low dollar. I mean, the stuff I'm looking at is still high price compared to the quality of it. I'm personally doing looking for apartments, and I'm right now, I think I'll shift over to maybe looking at mobile home parks.
okay.
So even though I have houses and apartments and stuff, and I'm just going to let those run, and then let the hard money run, and then just shift over to mobile homes or apartment buildings.
Hmm.
Even the apartment buildings that I see, they're asking for twice as much as they're worth based off the
Yes.
cash flow.
I suspect that that's gonna be changing it within the next 12 months pretty seriously. I mean, people can still ask whatever they want,
Oh yeah.
but I
Hmm.
think there's going to be some real opportunities in that side of the market from what I'm seeing. But are rents still pretty affordable, like relative to purchase prices?
Uh, r- Rents are actually higher than what they were a couple of years ago. I think they're crazy high. I'm not in that level because I don't want to be at that level. I want to be a little bit under that and
Well,
keeping
what
full.
will a 3.2 in a C plus B minus area sell for?
I've seen I'm looking at rentals are going for $1,300 a month rent.
Okay, and that house would sell for what?
Uh, I think I've seen them like 120.
Okay.
So they're under
So
the 1%.
yeah, that's way more in line with what we were all used to 10 years ago.
Hmm.
I mean, yeah, I mean, Cincinnati, that would have been a more expensive house, but it also would have had more expensive rent. And now you can't, like, 120 is a junker in a C minus area in Cincinnati now.
Hmm.
So you and some other people, like the folks from Louisville, the folks from uh, areas that are a little more small towny, are still seeing price to rent ratios that sort of work.
Right.
Where, like in Columbus, that house that's going to rent for 1,300 a month is going to cost you $210,000.
Yeah, probably.
Yeah, and it's those markets, the smaller markets, tertiary markets that still have that kind of ratio. They're the aberration. Most markets have long departed from that.
Yeah, for the moment at least. Okay. Um, let me show you what we know so far here, and then we can talk some more about what does it mean and what do we do, because the more important thing is really not what is going on in the market. It's how do we use the fact of what's going on in the market to keep right on making money. Did I forget to share my screen before I turned that on, or can you see my screen?
No, we just have your background right now.
Oh, goody. So I have to shift back over here. And then I have to remember to actually share the screen, not just set up the slideshow. There we go. June 21st, 2026, 6 years and 1 month into being on Zoom full time, and I still don't know how to use it.
Moving target.
Um, so yeah, well, I'd welcome everybody. I really appreciate you coming out on particularly a Sunday night. I know this is a weird time for uh, a monthly fireside chat kind of thing, but we were just trying to be careful not to step on anybody's regular RIA meeting. And you cannot have things any other day of the week other than Sunday and not be stepping on somebody's RIA meeting. So I just want to share some of the marketing trends, investing trends, or the market trends, not marketing trends, investment trends, what they might mean for our future, and what we can do to make money. Because the good thing about our business is that we are in a commodities business. And even in a recession, the thing, especially in a recession, the thing you want to be in is a business that people cannot do without. You want to be in oil, and you want to be in energy, or you want to be in food, or you want to be in something that is not don't need a house this year. We can go do something else other than live someplace. So just looking at what's coming out in the news constantly, um, real estate prices are just kind of more of the same this year. Like if you look at last year versus this year, in most places, whatever it was doing last year, it's doing the same thing this year. Affordability is still pretty awful. It's getting to where in most parts of the country, it is actually cheaper to rent now than it is to buy. And that is showing itself in the purchase numbers and the fact that some huge percentages of the mortgages that are being written today are being written to people with credit scores over 760. There's not a lot of um, FHA type buyers running out trying to buy a house because for the most part, most of the country right now, they can rent that house cheaper than they could buy it with mortgage rates being what they are and taxes and insurance and the mortgage insurance and all that stuff being what it is. Now, um, a lot of these slides that I'm going to show you tonight all came from a single presentation that was done by Apollo a little while ago. That's not where the slides are actually sourced elsewhere, but their presentation they were doing was a little bit. It was really about like new construction, but they had some really useful slides, so I stole them and now I'm crediting them. Um, Days on market have gone back to about what they were before the 2020, let's print a bunch of dollars and drop interest rates down to 2%. And that's been on a kind of constant upward heading, except for just a little while there at the end of 2023. I would expect by 2025 they will be above where we were well, they're already above where we were in 2018, 2019. So that continues to be a holding costs challenge for people who are buying to fix and sell. But on the other side, it is also a holding cost challenge to people who need to sell, not so our sellers that we generally work with, which are not the ones who like I'd kind of like to sell because I'd like to get another house. The people that we normally work with are people who have to sell. Something bad is going to happen if they don't sell. So increasing days on the market is a good thing or a bad thing, depending on whether you are buying or selling right now. Residential listings had popped up a bit, like middle of 2024, but then they started to come back down again in 2025, and we will see what happens in 2026. Listings are obviously different than sales or days on market. Listings is kind of about who has decided that it's time to either go do something other than own or more likely go buy another property. There was a huge new thing that happened in the market in 2025 that it's not that there aren't people who put their houses on the market and then decide that they're not going to sell for what they want, so they're just going to take it off the market and wait for a better time. Like there's those people in every market, but the level to which that was true from the middle of 2025 through the end of 2025 and then in spring of 26, a lot of them put their properties back on the market hoping that things were better and are now pulling them off again. The delisting, those are called delistings. And the delisting rate in some of the let's call them bubble cities that went way up in value, and now that bubble has popped. The delisting rate was like 45%. Like 45% of the people who put their houses on the market in Miami last year took them back off without a sale. And 45% of the people in Denver who put their houses on the market took them off without a sale. Now, obviously, those are not our typical sellers because if you took your property back off the market rather than drop the price, that's what that means, delisting, right? I want my price. So if nobody wants to pay it, I will just stay where I am. Those are not our sellers, but I think it says a lot about their expectations about pricing versus what is actually happening in the market right now. So, what you're experiencing does depend on where you live. The Midwest has been tracking better in both days on market and way fewer delistings. Like stuff is just selling better in the Midwest than it is in the rest of the United States for right now. Now, I will say again, I know markets are local, strategies are not local, but markets are local. And maybe out of my Ohio friends will turn out to be right, and we will just miss the whole actual drop in rents and actual drop in prices. But I don't think so. That's not what, that's not the way this usually works. The way this usually works is whenever the market is going to have a change, it starts out in California and it kind of rolls across the country and it eventually hits everybody. In fact, the Northeast was also tracking above everybody else in price increases, lower days on market, etc. But that seems to have ended over the last couple of months. So when you look at median single family existing home prices, that's not average, that's like, right in the middle. It's the price that's right in the middle. You can see that the West had a way bigger peak in 2021 than the rest of us did. And also, they were the first ones to kind of crash and burn when, the Fed raised interest rates 7 times between May of 2022 and 2024. And the West took the hardest fall, right? And it's bounced back a little, but it's still bouncing around the zero mark here. The South had the second biggest peak because everybody was moving there during COVID. And they also have taken kind of a big dive. The Midwest is the orange, so we didn't have the giant peak, but also we're the only ones right now who have had a positive year over year change relative to last year. And this is what I meant by the Northeast was doing great, but look what's happened here. So is that a seasonal blip because we had a super cold, snowy winter last winter, or what are we going to see when the final numbers come out? So the market is not crashing. It is grinding. We're all still dealing with high prices, high interest rates. We keep waiting for something to break in one or the other of those two things. Like either prices have to go down or interest rates have to go down, or people are just going to continue to have to sit on their houses. And not everybody can continue to sit on their houses. And yet it still grinds. That's just the reality of the market. And a lot of people are going, "Oh my God, it's echoes of 2006. The market peaked." No, it is not echoes of 2006. And in 2006, when the prices peaked, and then the next summer, the subprime market kind of just fell apart, just like company after company after company after company was going belly up. It was very quick that prices dropped very far. And it is not like that at all right now. Because clearly, despite the fact that we are not seeing the massive price increases that we had gotten used to there for a minute, we are also not we're not dealing with an overabundance of housing. We're not dealing with too much housing supply the way we were in 2007. What this reminds me more of is the 70s. Now, it's not like Yes, that's right. I am 85 years old, and that's why I remember investing in the 70s. That is not why I remember investing in the 70s. I don't remember investing in the 70s. I do remember that vaguely that my dad was investing in the 70s, but I've read what was going on during that time. And the high inflation, the gosh, we're at war with Iran again. Um, the the uh wages not keeping up with house prices, and the fact that there were just years and years and years in there where the market was just kind of stagnant. Prices did not go up a bunch. They also didn't go down a bunch. Um, Housing seemed to kind of get increasingly expensive because at one point, like in 79, the interest rates actually reached 22%. That didn't mean nobody bought houses. It meant that everybody who couldn't afford 22% interest rates bought houses using creative finance. So it really more reminds me of the 70s. And if that's the case, we could see 10 years of a market like this where prices are just creeping up a tiny bit and people are not able in to there are more people who aren't able to buy properties traditionally. So I will say if you've only been in real estate since maybe 2012, like when the market just started going up and didn't stop for a really long time, that the skills that were being rewarded in 2020 and 2021, particularly in the buy, fix, and sell world, in 2020 and 21 and a little bit into 22, this the thing that would make you money was find a halfway decent deal and jump on it and pay whatever you had to for your financing and just move really fast because it was going to be gone if you didn't move really fast, and then fix it up. And if it goes over budget a little bit, that's okay because it'll be worth 10% more by the time you're ready to sell it anyway. And an okay rehab is good enough. Like that is not, you cannot coast on demand and appreciation anymore in the buy, fix, and sell world. What the market is rewarding right now is careful consideration, careful offers, keeping on budget, doing a skilled rehab, not a half-assed rehab. I have a present for you if you need to get up to date on your valuations, because also I've done some forensic looks at my own books, and I can tell you absolutely positively that most rehab costs have doubled since 2015. 2x. And they're kind of a moving target. So I try and keep really plugged into what does it cost to put in a basic level replacement window wrapped? What does it cost to put on a square of roofing? What does it cost? Because it changes all the time. And if I'm not keeping up on it, then the offers that I'm making are outdated as to what it's actually going to cost me to fix it up. So there is a class on Tuesday, the 30th. It's on Zoom. It's at 7:30 p.m. It's with Jerry Fink, who is the former comptroller of this group. And he is also the past president of Cincinnati OREIA, and he's also done 230 rehabs. It's basically about how to estimate repair costs correctly right now. And if you come, he's even going to give you a 2026 cheat sheet. Go to your local group's website and see if it's on there on the 30th, because that way you don't have to like go through a whole big registration process. But if not, you can register at corerocks.com. You'll just have to like make an account on the page to do that, but it's free. So rentals also more challenging. Does it feel to anybody else like there has been an overemphasis in the past 7 or 8 years on finding and financing rentals and not enough emphasis on how to run them once you had them? Does it feel like the hot topic has been the buy it, rehab it, rent it, refinance it thing, and not the how to continue to run it properly after you've got, because then the next thing in the burr is repeat, right? It's not, and then manage it well. So some of the same challenges apply here, right? High prices, high interest rates, taxes going up, insurance going up, maintenance going up, and rents not going up that much. In places like San Antonio and Jacksonville, rents are actually down, and in some cases down significantly versus what they were 5 years ago. So when all of your expenses are way up and your rent is not up or it's even down, and also you don't do a good job of managing your properties, you don't keep things under control and screen tenants well and all that stuff, it's going to be a real problem. Of the 100 largest cities in the US, 56% have had rent drops. See, the green part is the negative year-over-year rent growth, and the orange part is positive year-over-year rent growth. So up through October of 2025, it was almost 50-50 areas that the rents were going down or had gone down year-over-year versus had gone up year-over-year. Also, vacancy rates are up. And I don't know that people who got into the business from 2017 to 2021 really know how to market rentals. I think they just kind of put an ad in Zillow and hope the right person shows up. I'm not sure that that skill of how do I actually get the damn thing filled hasn't been a little bit lost in the shuffle. So the green is the vacancy rate for rentals, and as you can see, it is bouncing up. Now, of course, it was at its highest back in the Great Recession when everybody and their mom moved in together with their mom. But look at it relative to what it's been. I mean, it's back to where it was in 2015, which again, like don't get all bent out of shape about this. This is a normal vacancy rate. It's just we're not used to it. And we're not used to buying and evaluating and running rentals like we were going to have an 8% vacancy rate. But we have an 8% vacancy rate. So if you are in the rental business, you're going to have a to-do list that you got to deal with right now if you haven't already. You got to fix your management. I mean, your goal is put the right people in and keep them for a decade. And people don't stay around for a decade if they can't afford your rental in the first place. And you put them in anyway. And you didn't know they couldn't afford it because they gave you a really professional looking W-2. So professional looking that it fooled your CPA. And yet they bought it off the internet for $20. There's an epidemic of that going on right now. And I was talking to my ex-partner the other day, and I said, I do not know how people who have not been in the business long enough to have a gut feel about their applicants are surviving, because 40% of the applications that I get have some piece of false documentation with them. And it looks real. It looks very professional. They paid good money for it. I would have been fooled had it not been for just a gut feeling that this the last one that I had was about 4 months ago. I was renting a very nice condo, and I get this story from this applicant that um she's moving into her first place. She's been living with her mother because she just graduated from nursing school and she's making really good money now. And I can call her boss and ask those questions, but that cost me $40. Have y'all run across that yet? These companies are hiring the company's called Workforce or something like that, and they won't answer your call if you call and say, "Hey, does this person work there and do they make this much money?" They say you have to call Workforce, and the Workforce charges you $40. Kroger's charging 10. Kroger's one of the biggest employers in Cincinnati, and they're charging $10 for you to find out if your applicant actually works there. So something about this whole story just was making me go, this doesn't feel right. Because she's like 34 years old. I'm going, like, she has lived with her mother that entire time. And I mean, how long did it take her to get through nursing school? Isn't that 2 years? There's just something wrong here. And so I did a little further investigation and I found an address on Been Verified that was a very recent address that was not her mama's address. And I looked it up and it's an apartment building and on the other side of town. And then I was like, well, let me look up this address she gave for her mom. And it wasn't even her mom's address, it was her sister's address. And I went, okay. So she gave us her sister's address and phone number because her mom wouldn't lie for her. And the reality is she's living in this other apartment and about to be evicted. So when we called her back to say, so we need to do some further checking because what is this address on Clough Pike? She's never returned the call. But someone's going to rent to her because they don't have that gut feeling or screening systems to go through and find that sort of thing. So you got to fix your management. You got to have your reserves. You got to know your numbers. You got to really, if you're buying new rentals, you really have to know how to figure out what the net rent is after your financing. And you have to buy at prices and terms that could potentially survive years of stagnation. When we get to talking about apartments, we'll talk about why we've had these high profile crash and burns. But one of the two main reasons is that they were depending on, I can buy this apartment building and then I can raise rents year after year. And that just might not be true in the foreseeable future. So the other thing that's happening, I don't know if y'all guys are noticing this around you, but a lot of people are dealing with the fact that rents are stagnant by filling other needs in the market. Um, Frank said really early on, and so did Mary Lou, that rents are just like unaffordable in their areas relative to what they used to be. Well, people still have to have a place to live. So the way they've been reacting to it, and this is not really new, it's just new to a lot of parts of the country, by moving in together. I've got a rental that's got uh the guy I rented to, and then he brought in three roommates, a couple and a single person. And it's fine, we've approved them, but that's not the strategy. Strategy is not to let people get roommates because then they're kind of in charge of the roommates, and that's doesn't always work out real well. The strategy is you just rent the house out by the room. and you can get a lot more money doing that. But of course, that requires its own set of systems. Dealing with a house where three strangers live together has its own set of requirements. Also, midterm rentals seem very hot right now, hotter than short-term rentals. Short-term rentals are kind of dying on the vine in a lot of places. The market's gotten oversaturated. Um, Lots of cities are just still pulling the rug after all these years, pulling the rug out from under all of their short-term rental owners and saying you must have 30 days or more. But a lot of people are going to 30 days or more and finding out that it works out fine. If you are personally in a deal right now that you're like, so, it's crashing and burning, whether it's, a rental I bought in 2023 at the top of the market, at the top of the interest rates, and it's not making money. It's never made money. And I'm trying to figure out what to do because I don't want to sell it and lose money. Or whether it's a rehab, I started out on a rehab and now it's gone over budget or it's not selling or whatever. Mary, this might be a good place for you to come on Wednesday night. The summit has a monthly help night, and that's coming up this Wednesday. That's also at 7:30, I think. Yes, it's also at 7:30. And this month is Save My Deal night. And I can't tell you how valuable these things are. If you will come and you'll lay out the facts to these folks, you will get 5 ideas that you never thought of yourself for doing the deal better. Maybe it's a deal you haven't done yet and you're trying to do it and it's not working out. These are just really good to listen in on. It's good to be there to help, but it's also good to be there to be helped, right? Deborah, you went on the last one of these we had and got your problem solved.
I did and managed to hold on to all of my properties and not have any of them go into tax foreclosure.
Yes, you did. So the good news, or back up.
Only part of it.
Or the bad news is that did did everybody else hear at the end of last year and the beginning of this year that in 2026 rates would probably get back into the high fives? I swear to God, I heard that. I heard that prediction multiple times, and here we are at 6.5. We're like up. We're not even down. We're up again, thanks to us going to war and the fears over inflation, oil prices, and all of those things. And that 6.5 is for homeowners. We're at between 6.75 and 7.25, depending on the lender, the credit score. Are you going conventional? Or are you going DSCR? The DSCRs tend to be a little bit higher. What's the price range? It's still really, really, really hard to get a loan under 100,000. And if you do, it's going to be on that higher end of the interest rates. So yeah, that line was supposed to be dropping down at the end, and it's going up at the end. We'll just have to see. Um, the flip side of that, though, is there's been this humongous resurgence in people understanding and implementing creative finance strategies. I haven't seen this many creative deals being done since I first got into real estate back in 1990 when interest rates were 16.5 adjustable. And everybody, including every real estate agent in the country, knew how to do creative finance because if they wanted to sell a house, that was what they had to do. You are not a slave to either paying cash or paying whatever the bank tells you have to pay. There's many other ways to do things, and you don't even have to learn them all. You can buy subject to and do nothing else and get properties with 3% loans on them. And you'd be amazed at the difference that a 3% loan makes versus a 7% loan on the same house at the same price in whether it'll cash flow or not. Leasing with option to buy is becoming a bigger and bigger thing. So I don't want to I don't want to take over your loan because you got a 6.5% loan. I'm not getting in the quicksand with you. But what I will do is I will lease your house with the right to buy it later at the crazy price you're asking, but that'll be 10 years from now. And you can get effective rates because okay, in a lease with option, are you really buying the house? Are you really buying a house when you lease option it?
No, you're buying the right to buy the house in the future, and you don't
Yeah.
have to.
And in the meantime, you're a renter. Did we just talk about how it's cheaper to rent than it is to buy in a lot of places?
Well, that's especially true in Tampa right now, in running the 6.6% interest rate on a loan at a discounted rate for what the property may be worth right now or a little higher. They have to put up $4,500 to $5,000 for PITI. If they go to the bank, it might be $5,250 a month, and market rates right now for that house are around 3,150 to 3,500.
Mm-hmm. Yeah, for sure. So there's a lot of landlords sitting around who would really like to not be in that business anymore, but they also can't sell. Well, they can sell because their properties are very highly appreciated. Like they bought, some of these people bought properties in 1984. And if they sell them now, they're going to have a 5 or 6 figure capital gains tax. Because I mean, they bought the property for $10,000, and even though they haven't been taking good care of it for the last 10 years, it's still worth 400,000, and it's fully appreciated, and they're literally going to have 100,000 or depreciated, and they're going to have $100,000 tax bill if they sell that property. So if you can go into them with a suggestion of rather than sell it, why don't you let me rent it from you? And I will give your kids $400,000 or maybe even $450,000, but not until after you die and they've inherited it at a stepped up basis. And in the meantime, you never have to think about another tenant. That's a very attractive offer to baby boomer rental housing providers who are sick of doing it, but they also don't want to pay the taxes. I think one of the reasons that we tend to think, oh, well, there's a lot of creative finance being done because that's the only way we can buy houses. No, there's a lot of creative finance being done because it is better for most sellers to get their full price in payments than it is to take a discount. I mean, in their heads, I can't argue whether it's really better in real life or not, but in their heads, it's better to get closer to their full price but take payments than it is to take a significant discount to get their house sold. So it's demand as much as anything else. There are not as many mortgages that are under 4% today as there were in 2022. There was a minute there when like 70% of all mortgages were under 4%, but enough houses have been sold at the higher rates now that it's only 50% that have mortgages at 4, 3, 2% interest. I really think that apartments are going to turn out to be the big story of 2026. And by story, I mean like the big new opportunity. And I say that because we had already had a couple of very high profile people that lost millions of dollars of investor money over the last few years. But this latest one that turned up, it is the highest profile in our world. Because in the true apartment world and like the big apartment world, not the influencer apartment world, those things are things that happen. This latest person got a lot of money from friends of ours and then went on YouTube about a month ago and announced that he had just lost $15 million in people's money and explained why. And when that sort of thing starts to happen, people really start to recognize that the market is different than it was, and you cannot depend on price increases, and you cannot depend on um, the financing that you have to get 5 years from now, because like that's how long your financing is 5 years. You can't depend that the financing is going to be something that you can afford in 5 years, because that is what happened. That is what is happening in these crash and burns, is a combination of optimism about how low interest rates were going to stay, which meant they bought at a price where, unless interest rates stayed low and also they were able to raise rents or cut expenses drastically, they couldn't afford a higher, like they couldn't afford a refi. They couldn't afford a higher rate. That's what happened to Brandon Turner. His financing was up. He went to the bank to get new financing, and they said, well, we'll finance it at 15 million less than what we financed it for the first time, because he wasn't able to raise rents. My understanding is this deal was in Texas. Texas has been one of the places that has been really hard hit by rent decreases. Nonetheless, I don't know where you live, but where I live, they're building apartments on every square inch of ground they can find. Apartments, and this has been going on for a long time, probably 10 years. It accelerated some in 2020 and 2021, but there's just an enormous amount of apartments relative to the new people who would like to move into them. And so the result has been high vacancy rates. There are more and more concessions going on in apartments where, no, we won't lower your rent, but we will give you the first month free. Oh, and a $25 security deposit. You can have a $25 security deposit. There are very high default rates right now on apartments. So you can see that completions, so like this is new buildings or new units on the market, continue to go up right until the end of 2024. The vacancy rate is climbing up towards 7.5%, which again, that's actually not an unusual rate, but it is way higher than people have been used to, or that they had been predicting in their pro formas. And the delinquency rate on apartments is, well, I mean, just look, like it hasn't been this high since 2011 maybe. And the orange is Fannie Mae and the green is Freddie Mac. So you would add those two together to get the actual total delinquency rate. So those are foreclosures and incubation. The delinquency rate is that high mostly because these folks can't get the refis they need. And eventually those are going to hit the market either as receiverships or repos. And there are going to be some deals coming. We're not seeing the bargains just yet because to some extent there's some extending and pretending going on. You know, I'm past the end of the 5 years that my original financing went on, but the bank hasn't foreclosed on me because I keep assuring them that the next lender is promised that they can get it done. Now, there's something else kind of going on in the background here. In another attempt to create a solution to something that wasn't a problem, as you guys might know, our friends in Washington have recently passed a law against hedge funds owning too many properties. They've decided how many too many is, and if you have exceeded that number, you're not allowed to buy anymore. And they did this after it's now been 18 quarters in a row where hedge funds have actually been net sellers of existing single family homes. They've sold more single family homes for the last 18 quarters in a row than they have bought. And the reason is they have shifted over into building single family homes. We are at a very high, and I think now increasing since they can't buy existing properties anymore, number of properties being single families being built for rent. It's like it that sometime in 2024 it got up over 9. It fell down back down in 2025, but it's going back up again. We've never, ever in a given year had that many single family homes being built to rent. So that might eventually have the same impact on existing single family homes that overbuilding of apartments for rent has had. So we're looking for a breaking point, right? The prices have to come down, interest rates have to come down. There's another possible breaking point. Inventory goes up. And if inventory in single family homes for rent goes up, that's going to free up some single family homes that are existing rentals for people to buy and should also help to moderate the rents. So you can look at charts all day long from very smart people like the people at Apollo. But what I find is that we, if we're hanging out with other real estate investors, tend to hear things before they show up in the statistics. And what I am hearing from my friends around the country is that sellers are actually starting to loosen up on their idea that I have to get what my neighbor got in 2022. They are getting more open to price reductions. They are getting more open to lower cash offers, and they're getting more open to financing offers. Everybody I know who's watching foreclosures in their state is saying, I don't understand why the federal government is saying that foreclosures are not really up, because I'm just seeing more and more foreclosures in my county being filed every single month. They're also saying that competition is way down. That when I go to my local real estate association, there aren't the big crowds there were there in 2021. I'm not getting all these deals, putting quotations around that, that I was getting from wholesalers a few years ago. I'm not finding that I'm fighting 19 other people for every off-market deal that I reach out and contact. And I'm also hearing it's weird how suddenly open agents are to things like, well, would your seller consider a takeover payments deal or doing some owner financing or possibly doing a lease with option to buy? What I've learned from all these years in the business is you just never panic. There are always deals in every market, but what those deals are depends on what's going on in the market. You cannot hold on to what worked even 3 years ago. You can't sit around and go, no, I'm going to wait until that market comes back, because you don't control that. That could be next year, or it could be 10 years from now, or it could get a lot worse, or you just don't know. You keep staying in touch with what's going on and what people are asking for, and you find ways to provide what they're asking for. You have to adapt or you have to quit. You adapt or you rot. I have learned that no matter how much you love a strategy and how good you are at it, doubling down when it's not working anymore does not fix it. Very often, all you need is a few tweaks to what you're doing. Like, I'm not saying get out of the rental business. Rentals are going to continue to be the way to build wealth in this country until they make it illegal to own rentals. Buy rentals, keep the rentals you have. You just need to be better at them than maybe you're used to being. I'm not saying don't fix and flip properties. Absolutely fix and flip properties. Just don't be stupid about how you're buying them. Don't expect that, oh, hey, we changed the rehab plan halfway through and we're going to spend 50% more money, but that's okay because we're going to get 5 over full price offers in the first week anyway. So why not? No, that's 2021 thinking. The most important thing you can be doing right now is being in the room with people who get this, who understand this, who can help you to make these adaptations you need to make, who can help you in the literal sense of, partnering with you or being your contractor or giving you things that you need, people who can inspire you, people who can teach you, right? People who can sit you down and say, okay, that doesn't work anymore. Here's how you have to do it now. Partners, folks who are optimistic and positive about the market because they're making it work for them, and people who are making it work for them right now. You don't want to be in a room full of people who are all sitting around going, boy, I wish we had the opportunities from 2021. Because I can tell you in 2021, all of us who've been in the market forever, we're going, man, I wish we had the opportunities we had in 2015. It's got to be people who are doing stuff now. So what are those rooms? They can be online rooms like this one and like the one next Wednesday where we're doing the help night, and the Tuesday after that where we're doing the free how to estimate repair costs right class. It's your quality real estate association. And I know sadly some of you live in places where the word quality does not apply to your real estate association. Some of you live in places where the group is full of sharks or full of people that all they seem to do is sit around and complain about tenants. It's not that lively, let me help you, you help me, make connections, build relationships place that you want it to be. In which case there are online alternatives. If you really live in a place where you just don't want to join your local group, there are other alternatives. But it also means make sure you get to the 2026 summit. That event has just become the nation's place for experienced, active, giving, helpful, there to build relationships people come to meet nationally. I mean, we all get to meet at our groups every month, but then how do we get together in person nationally? It's at the national summit. Everybody says be in the room. This is the room they're talking about when they say, "Oh man, you got to get in the room." Yeah, this is the room. If you don't have tickets yet, it is November 5th through 8th here in Cincinnati at the Great Wolf Lodge. As usual, there's a bunch of education. There's all the topics you never knew you needed to hear, but they are market relevant. We've got Tiffany Ray coming to talk about how to put together houses that rent out by the room, and we've got Lindsay Jensen, who's going to talk about her business of lease optioning houses from other rental owners, and Kathy Kennebrook talking about how to get off-market deals. And I swear I did not just fill up this entire event with women. There are, in fact, guys too. Jay Redding is going to talk about his, he just lives over in Indiana. And he's had a business for 10 years where he does not rent properties at all. You want to remove yourself from the rental business and put yourself in a business that people really need. People really need you to finance houses for them. And that's what he does. He buys houses, often like subject to the existing loan or something, and then he turns around and sells them on owner financing so that those other folks absorb the taxes, insurance, and maintenance that's killing us. So there'll be like 40 different topics. Like I'm not going to sit here and go through all of them, but the really cool thing is the people who come year after year after year that are just like the top. They're like multimillionaire independent real estate investors who are still just there to build relationships. They're not there to brag about how cool they are or get investors, or although there's a lot of deal making that goes on out in the hallways. So the tickets right now are only $247. They go up every single month from here on out. And you know you need to be there anyway, so you might as well get them while they're cheap. And I think you can add a partner for $120 right now, like a spouse or family member or business partner. And all of that is at nationalreisummit.com. And you're going to notice the speaker page says coming soon. That's because I haven't had time to sit down and write up everybody that we booked. And we are still booking. We are still booking some people, in fact. So yeah, definitely be at that. That's one of the best things you can do for your real estate career every year. nationalreisummit.com. Deborah, can you put that in the chat so I can stop my share so I can see everybody? Thank you.
It's in there. Thank you.
Okay. All right. So what did you take from this?
Well, I'll just throw out there, I don't feel so bad about my rentals and about the filling them slowly and, having longer, days on market and a harder time filling a vacancy or higher vacancy rates. I've heard you talk about this for about 2 years that it was coming, so I was kind of aware of that. Still doesn't make you feel better in the moment. So yeah, I've dug out some of my notes from previous conventions and whatnot of how to fill vacancies and how to market those a little bit better and refocus those efforts. So
Mm-hmm. Yeah, and again, the thing I said toward the beginning about how we have taken all the focus off of operations and put it all on acquisitions. It has not been good for the industry. It's not been good for people inside the industry. And of course, we never did that. We had an all-day class last year that included, it was how to find and finance, but also manage rentals. But the industry has done that. When you look at what courses are people selling online, it's not how to be a good rehabber. It's about how to find rehabs and then get private money and then make a fortune. And they kind of skip the whole part about how do you do a good rehab. Because when everything is selling in a matter of days for above full price, it doesn't matter if you know how to do a good rehab or not. Even a bad rehab's going to sell. But most of the time, it matters. All right, what else?
I'm looking
What do you
forward
get?
to the opportunities for apartments. I think it'll
Yeah.
it'll be good. So I'm gonna sell mine at a good price now and then buy something else when they get cheaper.
Yeah, I will be happy to invest with you on that, but I'm not going to go looking for them myself.
Also, I will say too that I think for the apartment side, one thing people don't aren't really talking about is the fact that all these people that lost money. I mean, I had a guy that put 400 grand of his retirement money in four different syndications. He lost three of them. He lost $300,000 of his retirement money. No deductions, no nothing. And those, so people will get gun shy and not want to buy these. And I think as we try to find investors, ones that understand it and they can look at your numbers and do proper due diligence. I mean, that is the big thing that you do the due diligence because people were buying, they were investing in 3.95 cap deals just 3 years ago. And it was just crazy.
Well, yeah, even 3 years ago, interest rates weren't that low.
No, they weren't. Well, I just looked at it, I shook my head when I was trying to evaluate those deals.
Okay, basic rule of investing your money, if the cap rate is lower than the rate on the financing, the deal's not going to work.
It does not work at all.
What about you, Mary Lou?
Yeah, I've been looking at apartments, and I'll tell you what, almost everything I've seen has been grossly overpriced. I was looking in, actually, I saw somebody sent me something in Cincinnati, and I looked at it. I was over $400,000. There was no way, based on just what the rents are right now, because I don't want to buy anything that isn't cash flowing right now. And this
Mhm.
had so many vacants. I mean, it was pretty much a vacant building. It had been rehabbed and it was a nice rehab, but they're asking way, way too much money and it's not running out.
Mhm.
I'm not buying something that isn't cash flowing right now.
Mhm.
And
Yeah,
I'm finding a lot of that.
that was a drastic break in conventional wisdom that happened. Um, I grew up learning you buy what it is. You don't buy what it could be. But for whatever reason, well, we know what the reasons were. It got really easy to raise money. That was the reason was social media. I can become an influencer. People will throw money at me, and then I can go out and buy stuff that we're not buying it for what it is. I'm going to show you the vision of when we raise the rents 10% every year for the next 3 years, and then we're all going to make $1 zillion. That actually worked out for people for a minute, but it was only a minute. And it's not working out anymore. And it was like that kind of slopped over into a bunch of different investment types. Um, we were talking on our Friday morning call to a gentleman who is buying a mobile home park, and I mean he had a really good idea for a future plan because there were like he could move properties in to some vacant lots and whatnot, but the price was the way the seller had priced it was based on if you do this future thing, then you will make all this money.
Mm.
And we spent quite a bit of time, you were there, we spent quite a bit of time saying, make a new offer. This is too much for what it is,
And
and
it
you
was
have to buy
almost
it.
half of what he had offered.
Yeah.
Yeah.
Yeah. So that I mean that's been a fairly common like investor thought. And I don't you buy it because of what it could be. You don't buy it at a price based on what it could be. So yeah, I think we're going to be getting back to some fundamentals now. And I think these people who are putting these apartments up on the market at what looks to you like 2 and 3 times what they should be based on the cap rate, I think they're panic selling either because they're like, oh, the market may have already topped out and it's time to get out, or they need to get that price to get out of their loans. And
I
that's a
think a lot
future
of them.
that's a future foreclosure, isn't it?
Yeah.
That's kind of what Denise just put in the chat, actually.
Yeah,
Yeah.
another thing that could become a really big deal is buying the financing
Mm.
on these apartment buildings because when the banks decide that they need to bail rather than foreclose, that you might be able to get it enough of a discount that you could then work with the other investors who are not lenders in a way that would ultimately maybe make the thing profitable for you. But otherwise, if you can't do that, you can foreclose.
And they do that. They do it all the time. I was involved with a deal where the bank wanted to get paid back. Payments were made every month for 10 years, but they had to refinance it. Nobody refinanced it. And the conduit investors of the bank wanted out, so the bank just sold the note. And then the person contacts the owner, tries to work out a deal to get them to pay it off, figure out what they can do, and works out well. I've also, though, I talked to a couple brokers. I was on a panel last month at the apartment association, and we were with a broker. He said that they still have plenty of people who were like the loan's going to be 6.5, and they'll buy it at a cap rate of 6.75. That is such a teeny spread. And these are all professional apartment. I mean, it's just, I'm supposed to be going to breakfast with them this week. But I'm just like, it's just absolutely nuts. That's such a teeny little bit of spread. I don't know how you possibly
Are
make that work.
those are those institutional buyers who have to buy because really the way they get paid is on a I got $1 million of your money invested and I get 2% of that as opposed to
No, I mean, well, I don't know. I want to ask her who's offering those because you do have people who are, I won't call them institutional, but they get, they're getting their 2%, they're getting their asset management fee, but then in my opinion, they're cutting their nose off despite their face because what they're going to do is they're going to ruin the reputation because the deal's not going to work long term. I mean, it's got to really be to me. If you're going to buy it at that cap rate, there has to be a significant upside, not just the Pollyanna, I'm going to raise rents 10%, but there needs to be something solid. In other words, they can still buy it at that. But again, if you're interest only, 6.75 and 6.5 is okay. But if you get a 6.5 amortized, it'll be negative cash flow
Mhm.
because the loan constant just isn't there. It's just absolutely bonkers. But so some of them are still doing it. So I think if you want to sell your apartments, I would do it
Do
now,
it now.
especially if they're in good place. The hardest part I found was that once I do that, then what do you do when you sell it? Because you want a 1031, but you don't want a 1031 into some stupid high priced apartment, right? So
Mhm.
it's sort of a great time to at least it was a better time to sell even 2 years ago, but it's still not a bad time to sell. But what do you buy, or do you just pay the taxes and then you take the rest of the cash?
Or do
I
you
don't
go
know.
to a
It's a
Delaware
real
statutory trust, or do you go to an Oz zone, or do you do Todd's thing of putting
That's
it actually
actually all
some
the items that I'm looking at for my building. So
Or
I'm
even
trying to work,
better,
but
do
I've
you
worked out.
option a financial friend's property and park
Well,
your
I have, so that may be something I'll talk about because I basically have somebody who's going to probably buy my building. Told them they can't close till January of 27. We're going to settle on a price. It'll be I'm going to do it at about a 7 cap. So that's still decent. I think it's a fair. They can probably get a loan in the upper fives from HUD, one of the HUDs or Fannie Mae or whoever. So they'll do okay. And but then I got to decide opportunity zone, deferred income trust, 1031, and then maybe there's something, you know, some creative thing that you can do. But that's the problem because the problem is if I sell it, I pay 450 to 600,000 in taxes. So that's a lot of money
and
coming
then
out
they're
of the
going to
cash.
take away your CPA license
Mhm.
for being an
But
idiot.
I understand. But if you talk to somebody like Sean McCluskey, he'll say, and I've in one of his groups, he'll say, are you going to do it based on a spreadsheet? Or are you going to based on what you want in life? So
You
that's what I'm
in
trying to
life
figure.
you want to pay $600,000 in
Yeah.
taxes?
No, the question is, do you want to go into an opportunity zone and have all that effort spent? In other words, are you ready to do that? Are you sort of ready to cut back and more lend out
In
the
which
money?
case you can call Todd.
Yeah, Todd and I've talked, so it's still possible. We're gonna do it. We're gonna talk.
Scott? We don't want you to be bored.
I wouldn't be
Yes.
born if I did nothing. So you're right.
Since I've sold most of my properties, I have time to do things like talk to people about this.
Okay, what else? What are you guys gonna do differently or think differently about?
I just want to back up something you said, Vina, when excuse me, when you mentioned you thought apartment complexes might be an opportunity this year. That's what I said last year when we did the millionaires panel. If I was starting over, that's what I'd be looking at. Smallish, 25 units to 100, 150 units that are below what the big boys want to buy. The institutional buyers, they're too small for them, and they're bigger than what the mom and pop buyers want to buy. So I think it's a great opportunity because there are a lot of them that are being sold already. There's a lot of financing that's not being renewed, and they're selling them for below or at what the previously financed amount was. So I think it's
Okay.
a huge opportunity.
So that's for that I would target building spot between 2017 and 2022. But there'd be a second set of those that I would target, and that would be ones that were bought before 2000. Because I think that um, there are awful lot of those that are kind of shadow for sale, by which I mean the owners don't want them anymore. But they also don't want to pay the taxes, and they will hang on to those things until they die or Medicaid takes them away before they will sell them. Like my dad was that way. He did not want to sell properties because he spent his whole life figuring out how to not pay taxes. And if he had Alzheimer's when by the time his big apartment buildings were sold, but if he had known that my mom had sold his 42 unit for cash and had a $250,000 tax bill, he would have divorced her. Her stuff would have been out on the street. But it was undermanaged, under rented, had deferred maintenance issues. Those are so ripe for lease optioning. Lease option does not just apply to single family homes. We've almost forgotten that was like the creative finance way to buy apartment buildings for a long time.
And that is the number one reason people who have owned properties a long time are not selling, is they don't want to pay the taxes. So if you can find a strategy, whether it's a trust, whether it's a 1031, whether it's a lease option, until they die, some way that defers their taxes and they aren't going to have to pay taxes, you've overcome their biggest objection and you're ahead of all the other buyers.
Mm-hmm. All right. Anybody else want to argue, amen, say what is different now than for them than was at 7:30? Get the link to sign up for the National Summit again, any of those things.
I'm hoping everybody already signed up while we were on this call.
Me,
All
I
right.
already signed up.
All right.
Anything going on legislatively that we need to hit?
I do think it is they when that bill in Congress federal level, 350 single family units were you're a bad boy if you've got more than 350, except the build to rent were exempted.
They're exempted, but there's something in the law about they have to offer to sell the properties to the owners in 7 years or something.
I
That
think
was
they got
The
that
removed.
renter.
removed.
Oh, that's
think they
good
Yeah, I
got that
think they
because
got that provision removed.
that's good because
Yep.
they couldn't do that because that's not how those build to rent subdivisions, those build to rent subdivisions are like mobile home parks. They're not each on their own lot.
It's one single plat, typically.
Hmm.
Yeah, that would add a bunch of money. If they had to separately plat each of those, that would add a bunch of money to construction costs. And yeah, we got a result in the Ohio Supreme Court dog bite case, but I'm still waiting for Maurice to tell me that I'm wrong about what I'm reading there. So you guys who live in Ohio, there was this Supreme Court case that we were very, very interested in. Because in the state of Ohio, there's been a law for many years that if you own or harbor a dog that bites somebody, that you're responsible for it. And the way that the law has been read in courts has been harbor means I have a house. You and your dog live in my house. I know that the dog lives in my house, therefore I am harboring the dog. So it was like it's been a real thing in Ohio that if you get bitten by a dog, you then go find a house that is owned by a renter who has a dog and say that that's the dog that bit you because the landlord has to pay. Like that happened to me. The dog that this lady claimed bit her, and she had a picture of a 3-day-old dog bite that she claimed was taken that day. There is just no possibility that my tenant's dog bit her. Well, the dog could have bit her, but he couldn't have bit her on the hand because it couldn't reach above her ankle. But she still sued me and said, I was shoveling his snow and his dog got out and bit me. And the guy was like, the dog never left the house. Like it just none of this ever happened. But we still got a call from one of the billboard attorneys. Anyway, so we thought that the suit, which was mobile home park owner, has a little dog park on his mobile home park, I guess, and a kid was bitten by one of the dogs, apparently pretty severely. So that's not a joke or anything to laugh about. But they sued the owner, and the owner said, "Not my dog, not my problem." And the court agreed, and then the next court disagreed, and the Ohio Supreme Court just agreed and said, yeah, he wasn't harboring the dog. But I think the reason that doesn't apply to the rest of us is that I think the people who live in these mobile homes own them, and he just owns the park. I don't think they're tenants.
What if they have renter's insurance?
Well, yeah, the renter's insurance is supposed to cover that, but just like our insurance won't cover the 7 breeds of dog that it won't cover, I think renter's
Right.
insurance won't cover those same 7 breeds. I could be wrong about that if there's any insurance people on here.
I didn't see Bill Pulte tonight.
Oh, I don't see anybody that I specifically recognize as an insurance person.
Mm-mm.
Okay, well, it's 9:01, so I'm going to bed now. Happy summer
Right.
solstice, everybody. Happy
Hey,
longest day of
sleep
the
tight.
year.
Don't let the bed bugs
Yep.
bite.
Thank you.
Good night.
Good
Very
night.
informative.
Scott, you can't
Good
talk
night.
about bed bugs in front of a bunch
I
of
know, I had to
housing
throw that in,
providers.
bed bug.
Bed
Now we're
bugs.
all gonna have
Father's Day to all
nightmares.
the
Thank
dads.
you.
Happy Father's Day to
Father's
all the
Day
dads out there.
Happy
to all the
Father's Day.
dads.
Thanks.
Bye.
Happy Father's
Good
Day.
night.
Happy
The
Father's
bed
Day.
bugs have been terminated. The fathers have been thanked.
Good night, all.